Hello, I'm Christopher Ewell from 10MinuteStockTrader.com, and today I've got a new video that I wanted to share with you, new video podcast, where we go over a new article that I wrote for MoneyandMarkets.com, also featured at NewTraderU.com and on 10MinuteStockTrader.com, called Controversial Ways to Trade Earnings Announcements. Got a trade idea? Let's talk about it. Trade Talks with Christopher Ewell. Now, with trading earnings, option prices are going to be higher than they would be otherwise. That's because of the unexpected moves that are associated with earnings. Sometimes they can be pretty small, and sometimes they can be hundreds of dollars potentially with a big stock. And the deal with earnings is that usually you want to sell premium. You want to take in a credit. You want to try and get the best value out of the trade by selling things when they're expensive. And usually that's done by selling an Iron Condor or by selling a Straddle or a Strangle. All of these trades are short premium trades, meaning you take in a credit on the trade and you have a defined risk, well, not necessarily risk, but you've got a defined profit zone. With an Iron Condor, you have defined risk, but with the Straddle and Strangle, you have undefined risk. And with these type of trades, it's very easy to watch a winner in the morning turn into a loser, and potentially a huge loser if the stock has an outsized move that you weren't expecting within just a few hours. Now, I've got two different trading ideas I wanted to go over with you today. The first one will be actually called the long strangle, and I'm going to pop up a picture of that right here. Now, a long strangle, you're actually buying two out of the money options, and typically you don't do that with much options trades because they can be very low probability. It's not something that people look to put on with the intent of having a high probability trade. And that was the case with me. I recently put one of these on in the Morgan Stanley earnings cycle. And the reason I did so is that it was just so cheap. I mean, when I was looking at the Morgan Stanley earnings trade, to sell a Strangle, to sell an out-of-the-money option pair, a call and a put of out-of-the-money options, and have unlimited risk, the reward was only going to be $22 for the potential of unlimited losses. And that's not a trade I was willing to make. The risk to reward ratio was not there for me. And I thought to myself, well, why don't I buy the Strangle? It's only $22. It's a lotto. Well, let's just try it. So I bought the Strangle at 41 and 46. And the next thing I know, the next day it opened up nearly 46. And by the following day, it had gone up to over 48. Now, this trade that I only spent $22 to get into turned into be a huge winner, and I never expected it to be the case. So that's why I want to present that to you. If it seems like the option prices are just too low to make a fair value trade for your portfolio, why not buy it? It's not necessarily going to be a high probability of profit. It may not win, but at the same point, it may run in one direction or another, and if you've got the long strangle on, then you can take advantage of that.
Now, you need a broker that understands options trading in order to make trades like I make. Tastyworks is a broker platform that I use and I recommend. The platform's easy to use and their pricing is unbeatable. And with their commissions, trades like this would only cost $1 per leg total. Now, if you sign up for a new account with Tastyworks and use the code 10MINUTE, that's 10MINUTE, I'll give you over $150 in exclusive 10-minute trader bonuses from 10MinuteStockTrader.com. Remember to use the code 10MINUTE, 10MINUTE, when signing up for your new Tastyworks account today.
Now, the second trade idea that I want to throw at you, it's somewhat controversial because it's actually after earnings are announced. Typically, whenever you set up an earnings trade, you do it at the close of the prior day. So let's say if you're in Central Time, market closes at 3:30. Let's say you put on a trade at 3:20. You're putting on your Iron Condor. Well, with this trade, this is a credit spread, an at-the-money credit spread after earnings are announced. So the following morning at 8:30, actually market closes at 3, opens at 8:30. So instead of taking off your earnings trade, taking off the Iron Condor, hoping that the implied volatility has come down, option prices are come down, you're able to take it off for less than what you sold it for. You're actually going to put it on after the earnings are announced, and you would only do this if you have a very confident assumption on where the stock is going to go. Let's say I did this in Netflix recently, and Netflix it ran away. It went up, 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 and up. And I had put on a put credit spread earlier in that morning. And the reason that this turned out to be pretty good is that I still put it on while the option prices were high, and that's key. You want to put it on while the option prices are high, that way you're taking advantage of that high implied volatility. But you want to be quick in taking it off like you would any options trade, and that once the prices come down, and it may not necessarily have to move very far, but once the option prices come down, that's when you swoop in, take off your trade, and hopefully close it for some quick profits. Now, like I say, both of these are somewhat controversial in the world of options trading, but I mean, they make sense to me. Instead of selling something that's expensive, you're looking at buying something that's cheap. For $22 on a Morgan Stanley trade, why not? And then secondly, you're looking to sell something when you've got an idea of which direction it's going to go. And it may not always work out that way, where it continues to go up. Or let's say you sell a call credit spread, and may continue to go down. But you are trying to take advantage of the fact that options prices will be coming down because of the implied volatility having already come down after the earnings announcement. You want to get in kind of a sweet spot where the announcement's been made, the big move, the overnight move, the gap move has been made, and at the same point, while option prices are still somewhat high, you can take those off hopefully not too long afterward. So anyway, that's two trade ideas that I wanted to talk to you about for this coming earnings season. One of them's low probability profit, the other one's high probability profit. But either way, with an earnings trade, you want to be sure to move fast. That's the deal with earnings trades. They move fast, and so you need to move fast. Be able to take your profits quickly, because they could disappear, and you could watch your profits evaporate. So thank you so much for watching today's podcast video on two controversial earnings trade ideas. And thank you so much for your time and attention, and thank you for stopping by. Our mission statement at 10MinuteStockTrader.com is to empower others to employ the strategic advantages of options trading and to provide confidence that they can profit in any market scenario. Please be sure to give me a like and a comment below and tell me how you can use this in your own portfolio. I have so much more content just like this over at 10MinuteStockTrader.com. There you'll find all the bullish, bearish, and neutral strategies I trade, as well as everything I've traded in my portfolio over the last year. Thank you so much for sharing your time with me. It really does mean the absolute world to me that I've become a part of your day. And like I always like to say, I've been your host, Christopher Ewell, and thanks for stopping by. That wraps up today's 10MinuteStockTrader.com show. I've been your host, Christopher Ewell, and thanks for stopping by. 10MinuteStockTrader.com content is for information and educational purposes only. It is not, nor is it intended to be trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10MinuteStockTrader.com and Christopher Ewell, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10MinuteStockTrader.com and Christopher Ewell are not in the business of transacting securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client's situation or investment objectives. 10MinuteStockTrader.com and Christopher Ewell are not licensed financial advisors, registered investment advisors, or registered broker-dealer. Stocks, options, futures, futures options, and any instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment trading decisions and for evaluating the merits and risk associated with the use of any financial security and brokerage platform. For more information, please visit 10MinuteStockTrader.com/legal. And thanks for stopping by.